Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 107. On today's episode, we're going to talk about the stock market as we always do. We'll discuss the Fed's meeting in Jackson Hole, Wyoming. We'll talk about why being nervous and having butterflies could mean that you're on the right track. And we'll also discuss some of the news stories of the day, namely Zillow and their 1% down new mortgage program. Is this good, or is this a sign of things to come a la 2006? All that on today's show. Get your mind right, and let's get to work. Well, welcome back to the show, everybody. I hope you had a good week, productive week. I know that I have recently been busy. So for me, it has been starting to teaching in a new school, teaching some new classes, having to prep those. And so last week I was a little busy. I was not able to record an episode as normal. I also had my other computer went down. I got myself a new computer. And I'm playing around with the sound even now as I record this. So if the sound is off on this episode versus others, I apologize. Hopefully I'll be able to dial it in here in the future. But yeah, so things are going pretty good. The stock market's kind of been bouncing around the last couple of weeks. August has not been a great month for the stock market. Usually August is the second worst month. And, you know, we're seeing that the market really hasn't had a whole lot of data to key off of. And so this past week we had some major news from NVIDIA, which is a company that we've discussed many times in the past. And then we also had the Fed meeting in Jackson Hole, Wyoming, where the Fed met. It wasn't a policy meeting, so they weren't meeting on whether they're going to raise interest rates or not. That'll actually come in the September meeting, and so you just kind of have all this data, right? So we have to unpack it a little bit. I'm always amazed. Like Jerome Powell has said the same thing in every single meeting for the last couple months, which is basically the Fed is going to be data dependent. They want inflation to return to 2%. They're going to hold the line until inflation returns to 2%. And for some reason, every time there's a meeting, the market or different investors expect him to say something different. And every time he comes out and he says, we're data dependent, the data looks okay, we're waiting to see if it stays the same. We want to make sure that we don't, stop this job too early. They don't want it to be like the 1970s where they thought they had beat inflation. They dialed back interest rates too quickly, and then all of a sudden inflation came back, and it came back even harder. And the Fed's committed to not letting that happen. So what are the implications of that? Well, you're starting to see some of it, right? You have mortgage rates above 7%, the highest they've been in 20 years. And so that really impacts young people, new-time, first-time home buyers. It's, people who thought they were going to buy a house a couple years ago and, hey, we're going to live in this house for a couple years, and then we're going to trade up. All of a sudden don't want to get out of that house that has that low mortgage payment. And so even for me, I moved over the summer. My new mortgage rate is 6.3%, and rates are already above 7%, and I bought my house back in June. So, I mean, even just a couple months ago, you've seen this tremendous impact. And so that really does impact people's ability to buy a house, to be able to move around, what their plans for the future are going to be. And so we'll talk about that in just a minute when you look at kind of what lenders are doing to try to entice people to get out there and actually buy a house. And so, but I want to go back to NVIDIA's earnings. NVIDIA's earnings were incredible. Just the demand is absolutely off the charts. That was a very good sign for the market. There's a lot of kind of, I'll say, hope built on this AI trend that's going to be happening in the future. How is it going to impact the world? Is it going to be up to the hype, so to speak. I mean, you have to be very careful. There's been many times over the past couple of years where all of a sudden you think that there's this new technology, it's going to change the world, and it turns out that it's just a fad. The one that comes to mind for me is 3D printers. So if you go look at the charts for some of the 3D printing stocks years ago, there would have been 3D Systems, their symbol's DDD. You'll see it spike up really hard, and then it comes right back down. Just really wasn't able to live up to the hype. If you go look at a company like GoPro had this great product, and then they were never able to come up with another one, and so you see this meteoric rise, and then all of a sudden it falls off. They just weren't able to replicate that kind of success. And so looking at that, I mean, you have to wonder, is AI really going to be this thing that's going to be here to stay, or is it going to be something that is a fad? Well, looking at it, when you look at NVIDIA's results and you see the amount of cells that they have, that H100 chip that they have such a huge lead over everybody else that it makes all of this stuff is going to be built upon that. And so an incredible quarter. They raised guidance, meaning that they're going to sell more chips next quarter than they thought. They've raised their guidance over the next year. And then they've also planned a buyback, right? So they're going to buy back their own shares to the tune of, let's see, how much did they say? Sorry. They are going to buy back $25 billion in stock. So buying back $25 billion in stock. In July alone, they bought back $3.3 billion of their own stock. So this is them using their free cash flow, money the company's making. They're buying back their own shares, which removes those shares from the market. And if you're a shareholder, reduces the share count and should raise the stock price over time. We discussed this as well. This is something that Apple does Apple is kind of the king here when it comes to buying their own shares back, and it makes a tremendous difference. One of the reasons that people and companies enjoy a buyback versus like a dividend is, number one, you're not married to a dividend. If you increase your dividend and then at some point you're not able to pay that dividend, you kind of get beat up on it. Also, when you pay a dividend, your shareholders have to pay taxes on those dividends. Whereas if you return money to shareholders in the form of a buyback, the shareholders do not have to pay taxes on that money you're spending to buy back your own shares. So if you have no intention of selling the stock and you want the share price to rise, a buyback is definitely a good way to go. Some of the negatives of that is that if you buy it back when times are doing too good and you're paying way too much for the stock, you can be buying at the wrong time, and then it looks like you were that you did not time that very well. If the stock drops after that happened to Meta before the fall of 2001, so it can be a bad timing deal. But it is a good sign. It means the company is making a lot of money. They want to reward shareholders, and they want to return some of those funds. And so NVIDIA is really, has just transformed this year. I mean, it's easily the best performer. It is easily the best performer of the S&P 500. If you just look at it year to date, they have gone from $143 on January 3rd to $460 today. I mean, that's pretty good. And so, you do have to wonder when you look at the valuation, are you going to pay too much for this company? I mean, there's a lot of positivity baked in, a lot of good news baked in. Guy Spear, the famous value investor, was on CNBC a couple weeks ago talking about, man, it's a great company. They're doing amazing things, but the valuation is just way too far out there for him, meaning that there's so much good baked into the valuation that they got to be right, every single time. They cannot slip up. Otherwise, you're likely to not get your money back. I will say, after they recorded this or reported their quarter, they jumped above $500 and then $500 a share. And then after Jerome Powell spoke at Jackson Hole, the stock started to come back down. It's at $460 now. You look at the analyst price targets of it, and everybody's raising their price targets. The average price target right now is $618, and that's off of 43 different analysts tracking this stock. So it's going to be one that, if you follow the stock market, if you're looking at it, it's going to be a stock that you hear more and more about over the coming years. And I'm still surprised. It's one of the only companies that has a valuation over 1 trillion. And I'm still surprised at how many investors or students or whomever that I talk to really don't know. It's not. I guess it's going to be. It's starting to be if everything goes that way. But they're still not like a household name yet. Not like the Apples and Amazons and those, which I find interesting. But they are going to be, again, an important stock for you to follow and at least have an awareness of, because it is going to impact how the market trades. If NVIDIA's quarter would have been bad, it would have been really rough for the stock market, especially with the Federal Reserve, their Jackson Hole speech, basically Jerome Powell saying we might not raise interest rates again, but we're definitely going to hold them steady, and we're going to hold rates higher for longer. And, the market is pricing in Federal Reserve rate cuts next year. And the Federal Reserve right now is saying, we're not saying we're going to lower interest rates. And so it's kind of this game of chicken between the Federal Reserve and the stock market on what's going to happen. So we'll see. That's not something we're going to be able to unpack today. One of the other things that I wanted to discuss was the fact that, somebody this week, I started classes this week, and somebody asked me if I still get nervous when I go into a classroom to teach a new class. And the answer to that is 100% always yes. I'm always nervous when I go into a new classroom, get a new group of students, teach a new class, all of those things. I care very much about, I think about how I felt when I was a student, and I think about getting my money's worth when I go into a class, right? Like, is this class going to be worth it? Is it going to be one of the classes I remember? Is it going to be worth my time? And so I'm teaching kind of some more advanced students this year. I have some executive MBAs. I have some professional MBAs. These are people who are working. They're going to school at night. It's different when you teach a class and somebody's been at a job for 8 hours, right? They're tired. You only have so much willpower in a day. And so you definitely don't want to waste people's time. And so, but I was thinking about it, I thought that was kind of an interesting question that somebody posed to me. And it made me think, like, I am nervous when I teach new classes. I'm nervous when I do a lot of things, but I'm not going to say that I chase that, but I do look for things that I feel like will make me nervous or will kind of get the butterflies going a little bit, because I almost feel like it's part of a compass that is like, okay, you got to keep challenging yourself. You got to keep growing. You got to keep, working towards something. Do something that makes you a little bit uncomfortable, because it puts you in a place where you got to be prepared. You got to be willing to put in the work. You got to be dedicated, and, you got to not embarrass yourself. I mean, I even get nervous, doing the podcast. I mean, I'm putting things out here, somebody could bring it up one day later on or whatever, but I mean, you just cannot live your life being afraid of things that are going to happen or not happen. I mean, most of the time, the things that we worry about when we're laying in bed, staring at the ceiling, most of the things we worry about, never come true. But I think that if you're moving towards something, if you're challenging yourself to get better, to take on new challenges, and you get a little nervous, you get those butterflies, it should be a sign that you're on the right track. So I enjoy that when I'm meeting with new clients for the first time, or these opportunities. I just feel like they don't come around that much, and especially as you get into your career and you've seen things kind of over and over and over again, you get used to it. So you're just kind of going with the flow that you've always gone with. And it's easy to just kind of do the same thing you've always done because it's safe. And, reaching out there and doing something new, grabbing onto something, sending the email that you are nervous to send, or send in the direct message that you're nervous to send. I mean, sometimes that can be, um, you know, a sign that you're onto something good. I mean, I mentioned it in the last episode, but reaching out to Guy Spear, the famous value investor on Instagram, and getting a video back from him and kind of being on his radar. I mean, that made me nervous for sure. So, there's things that that you can kind of catch yourself doing to just kind of get you out of your normal daily routine. And so when I go into teaching every single year, I'm always a little bit nervous. You never know. All the classes are different. The personality of the class is different. The first week is always like the most nerve wracking, because they don't know you. They don't, they have no preconceived notion, I guess, unless somebody's told them something. But it's always, it's always different. Every single class is different. And so for me, I enjoy that because I have to be, prepared, and I got to be, ready to handle things that maybe I'm not expected to handle, questions that I don't know are going to come up. And so you gotta stay sharp. I mean, it's a great environment, especially for somebody like me and the things that I do. So the other thing I wanted to bring up was this article that Zillow is now going to allow you to buy a house with 1% down. And so this article, or the soundbite of that, got put out everywhere, right? Zillow is going to allow you to buy a house with 1% down. And I looked it up, and it's only in Arizona, and you have to be a first-time home buyer. And they're going to give you a 2% grant, because normally the minimum you can put down on a house is 3%. 3% is the minimum you can put down on a house. And so Zillow is trying to help out, because interest rates are so high that there's a lot of people who just simply cannot afford a house. And it changes dramatically when you go from a 3% interest rate to a 7% interest rate. I mean, just go grab a loan calculator and look at the difference. It's tremendous. And so, but it made me think, they're getting these headlines, but it really did start to remind me of the last time interest rates were this high, which would have been the early 2000s, and how then we had, people, lenders making loans for basically no money down. I bought my first house in 2007, literally, I think like 4 months before the financial crisis. And I put zero money down, bought a house for $220,000. I didn't put a single dollar down on it, which is crazy. Today, I mean, it's very much different. It's very different. And it's one of the biggest worries of people who are younger is, will I ever be able to own a home? And so Zillow starts to do this. You have to have a minimum, credit score of 620. So it's a little bit different. It's a little bit different than the early 2000s. It's a little bit the same. And so I'm just, I'm wondering if this is like the start of, lenders and mortgage companies getting a little bit more aggressive, kind of like, is this something that we need to, look out for? But it did make me think of a topic I don't think we've talked about on here, which is PMI, which is private mortgage insurance. So if you buy a house and you put down less than 20%, you will be required to include in your mortgage payment PMI, private mortgage insurance, which protects the lender. If you quit paying your mortgage, it protects the lender and kind of makes up for it. But it's more expensive than you would think. I mean, you can find these PMI calculators everywhere. I'm using the one at NerdWallet. But on a $350,000 house, if you put down 10%, which is $35,000, you'd be required to pay PMI. So if you have to have PMI as part of your mortgage payment until you have 20% down. And so on this example, $350,000 home, 35% down, $35,000 down, which is 10%. Your monthly PMI is it's basically $394. So almost $400 a month you would be required to pay in the form of private mortgage insurance. Now, there are some of you that'll get that. You'll get a better job. You'll start making more money. You'll start paying more down on your house. The PMI thing is something that you kind of need to make sure that you track yourself, because normally they'll just take your original home payment, and like on this example, it take you about 8.3 years to get to that 20% level. And so if you get there quicker, you got to call them and you got to get it turned off yourself. You got to get that PMI turned off yourself. They're not just going to do it for you. And so if this is something that you've done or you've been a part of, just make sure if you buy a home, your financial situation changes, you start to pay PMI, you get 20% down in your home quicker than you think, you can get that PMI turned off. And by the way, it's not just the fact that you get 20% down because you've paid it in. It could also be because your house is actually appreciated in value. Although that one's a little bit harder because you might have some fees as far as like having to get the home appraised and things like that. But it's definitely one of the things that you want to be proactive with. If you have PMI on your mortgage, you want to be proactive with it and kind of make sure that you're just doing a comparison of it every single year to see where you're at, especially if you're paying a little bit ahead on your mortgage. Remember, if you have a 30-year mortgage and you make one extra payment a year, that's going to take about 7 years off your mortgage. So you can take a 30-year mortgage, turn it into a 23-year mortgage just by making one extra payment a year. So, and especially at today's interest rates, I mean, if you're at 6-7%, I mean, that's something you're definitely going to want to pay more attention to. And it's going to be more important than it was when interest rates were 3. So definitely something to keep in mind. Okay, well, I hope you have a great week. I hope this was helpful for you. Don't mistake activity for achievement. We will see you next time. Thanks again, everybody. Have a great week.